Hey, welcome back. Today, with a very unpredictable macro environment and fundamental trends advancing, beer and other alcohol companies face a lot of volatility. Almost all of them seem to be in a transition stage where the generational changes in consumer behavior dictate a change towards premiumization, as you'll see in the video. Some are pretty much ready to enjoy it, while others are forced to adapt, so let's look into them. A general risk before we begin will come from politics. We saw Trump talk about huge tariffs on some beverages from Europe, which can then retaliate and affect everyone. Europe and the US are generally the main markets for everyone in the video, while South America, Africa and maybe SEA are the growth engines. An unpredictable blow to the main cash generators can affect any of them significantly. On the bright side, that can open some opportunities, and when they are lifted, the market could react very well. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even two each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. To begin with InBev, this is the largest non-Chinese brewer, known especially for Budweiser, Corona and a few other brands of beer. The revenue grew a little bit last year, but the EBITDA and EPS saw significant growth, basically recovering to the level from 2 years ago thanks to some cost savings. They are focused on optimizing the business, improving the margin and cash flow while continuing to invest and diversify. They made a very nice 11 billion cash flow last year thanks to lower capex and higher operating cash flows, placing them at a ratio of around 11. That's around a 20% margin on the revenue, which is actually very good. For a reference, that's basically the same revenue as Cisco, Oracle or HP and either the same, twice as good or even 3-4 times better cash flows, so not something to ignore. As you'll see throughout the video, ignoring the politics that had an effect this year, beer companies tend to be valued lower, I guess because of the market's expectations. Especially the lower quality and further they are from premium overall, the lower the valuation because more investments are expected. Financially, they aren't in an amazing position because the current assets don't cover the current liabilities, but with the cash inflows and a bit of credit, they should be okay. We see a lot of goodwill representing the estimated value of the brands, which you'll see in every other company in the video. You know, sell Corona or Budweiser if they really have to, and that's potentially paying for a majority of the debt, if not all. The debt is also spread very well into the future, with 97% of it having a fixed interest rate, so really not much to worry about from this point of view. It's generally 3, 4, 5% interest, generating around 4.5 billion in expenses per year. They mentioned this premiumization that you'll see in every other company. Basically, due to trends, economics, maybe even knowledge, people started going for better for you options rather than the classic beer sold for the volume. They invested into expanding beyond beer, as well as no alcohol, gluten-free, zero sugar, organic or low calories options. This category actually delivered a bit better results than the traditional option, although it's still a small side of the company, but it's supported by long-term trends in demand. Something that sets them apart is the focus on direct-to-consumer. It's a tiny fraction of the company, but we see 8, 9, 10% growth in that as well. But this is especially good for marketing because they can introduce new products to millions of high-potential buyers for a very small cost. Even if they were to lose money with this, it can potentially save billions in marketing for the same results. You know, if you are a user on their websites, they know you like beer, are likely to buy it and even know what you like, your age, birthday and stuff like that. They announced a 2 billion buyback program back in October on top of the tiny 1.5-2% dividend that they increased quite a bit this year. That's a payout of around 40% together for a combined yield of like 3-4%. It's not amazing and I think it's among the lowest in the video, but they have potential for more. So I guess it's a good one to begin with. Not bad, makes a ton of money on a great margin similar to tech companies and pays an almost decent yield that can be much better. They have quite a bit of that, but nothing that they shouldn't be able to manage, so I guess it's an okay one to keep in mind. Now Heineken, this is among the most popular beer companies on the planet, or probably the number one according to them. As a note, you have Heineken and Heineken Holdings both being public. The holding company is more than half owned by the Heineken family and owns basically 50% plus one of Heineken itself. I look into Heineken itself, not the holding company. That's basically a board of directors and only makes money from the dividends they get from the company. Despite a stable revenue, they can make even more than 3 billion per year now, which is not bad for a 45-50 billion market cap. They were actually close to 30 billion at the beginning of the year, meaning a ratio of around 10, which was not bad at all. Again, and this is actually the reason why I make this kind of video, doing your research and being ready and already knowing what to buy and when to do it is very important. When we have the opportunity, which in this case came for only a couple of months, we may not find the time to look into it and miss it. Financially, we see not an amazing position, with the current assets below the current liabilities. There is about 22 billion in equity, which wasn't far from the market cap back in January. However, they do a lot of acquisitions, and we see brands valued at around 9.7 billion already included, so the discount isn't that high. We see the bonds being spread very well into the future, and the interest rate is actually very small. The interest expenses aren't that high, but they went up in recent years for obvious reasons. The dividend policy is 30-40% of the net profit, meaning 1.86 euros per share this year, a 7.5% increase, meaning 1.04 billion. That's a payout of 38% for not an amazing dividend, but again, buying it at the beginning of the year would have been a yield of like 3.5 to 4% now, so already much more interesting. I guess there is kind of a reassurance with the holding company and even the Heineken family kind of depending on this company paying a dividend, so they'll likely keep paying it maybe even forever. They bought quite a few companies lately with a focus on Africa, as well as a canned cocktail company. As you'll see throughout the video, a majority of them seem to go for more of an experience rather than a volume market. That's pretty much a response to trends we see especially in developed countries where quality beats quantity. That's why you see a majority of them go for cocktails, ciders, premium IPA, brewery, whatever, rather than the classic big bottle of questionable quality. Not to mention that they also reach new people this way, so it's even better. They have this evergreen plan that includes the premiumization and expansion, as I said. We see impressive growth especially in Africa and the profit in the Americas, and what's very impressive and could say a lot about the future of this market is the growth in zero alcohol drinks. They have a lot of brands of zero alcohol beer, and in total they grew at double-digit numbers in 28 markets last year. What makes it impressive is that the company is actually the global leader in this category. I think they are in a position where they can use the stock to buy the smaller local competition if needed, while also investing a lot in marketing to at least keep this market share and benefit from the trend. So overall, at a first glance, I like it, but the balance sheet could be improved. If I had done my analysis before, I probably would have bought a bit at the beginning of the year. This is why it's important to do it even if things may not be the cheapest right now. It would have been a much tighter gap between the equity and the market cap, potentially making it an acquisition target, a decent dividend, and making enough to even do significant buybacks or improve the balance sheet. Now, Diageo, they have some of the most popular brands of whiskey, rum, vodka, liquor, and even beer. The stock is down pretty much in half since the peak in 2022 due to the common weak demand and now fear around the environment due to tariffs. At the same time, and to adapt to the environment, they are doing both portfolio expansions, buying new brands, investing in production facilities, and cost savings. They actually managed to save around $500 million per year already, which is definitely not bad while developing. From even more than 4 billion per year, they dropped to around 2.5 now due to double the capex and weaker operating cash flows. It's not terrible for a 60 billion market cap, but I feel like this is a bit optimistic given the environment. I would have expected the market to be much more pessimistic, but I don't really see that much fear yet. But it's true that this is under lower price to cash flow ratios, so not absolutely speaking, this is actually cheap for them. They are among the most diversified when it comes to popular brands, and that has to be an advantage, and to be fair, they could even buy something like Heineken and actually dominate everything. Being valued at basically twice that company's ratio means a clear positive addition to the company's cash flow while getting some more potential to grow and very popular brands. You know, Heineken makes basically the same today, while they could probably buy them for like 60-70% of their market cap, so clearly profitable. Financially, we see an okay position, with the current assets covering the current liabilities and enough assets to offset all the liabilities. There isn't that much equity, but I'd say the brands that they have are worth much more than 14.7 billion. Maybe not justifying the difference, but definitely closing the gap. They pay around a 4% dividend now, each ADR is worth 4 shares by the way, so around 2.23 billion, which is fine for a 2.5-3 billion cash flow. But if the issues continue and they are forced to adapt, this could become a burden and they might have to cut it quite a bit. On the bright side, that could mean much better prices, and when the tariffs and everything is over, we know that this could potentially pay very good yields. I think it would also be a good time to start some buybacks, but they don't really have that much free cash flow available. Another trend that they mention is Gen Z getting into that period of life where they need something stronger and they go for spirits rather than beer. Jokes aside, we actually see a very significant increase since around 2020. You know, more money, better taste, and to some degree also an effect of premiumization. So definitely an interesting option with $13 billion brands, especially in premium and super premium, which should be very good for the long term. They also talk about this premiumization of the customer, which would be very beneficial for a company that's mostly premium or even better. They have the advantage of a strong valuation that's above the market, which would allow them to really expand very efficiently. Say they buy Heineken or Coors. They basically pay $0.50 per share for even $1 per share, so it's literally pure value for them on top of getting even more very powerful brands that they can develop. Now Molson Coors, this one is a popular beer company that also expanded into non-alcoholic beverages in recent years. We see a kind of flat performance, although they also went down at the beginning of the year. They grew only a little bit since the pandemic, but the margin remained pretty good except for 2022 when they had some non-cash impairments affecting the net income. But they can make pretty good money, currently being at a ratio of 10 or even less. I think it's actually the lowest ratio we've seen in the video and kind of common for beer companies to be traded lower. But this is kind of a medium to low end beer company, so it's kind of justified. They have to invest a lot into non-alcoholic and premium products if they want to keep up with the trends. But we actually see them do that with zero alcohol options for pretty much everything, beer with flavors and similar things. Financially, we see an okay position with the current assets around the current liabilities and a lot of assets to cover the debt. What's setting them apart is that at the moment of recording this, the equity is a few billion above the market cap. But basically more than the equity is goodwill plus intangibles, so you rely on their valuations for the brands, same as with all the other companies. The dividend is a decent 3 to 3.5%, meaning about 390 million, which should be very sustainable. On top of that, they return the rest of the cash flow as buybacks for a total yield of like 10%, which is definitely attractive. The buybacks were actually very significant in 2024, reaching a yield of like 10% only from them. I think given the environment, the valuation and everything, it's not a terrible idea to do them now. However, they have to balance it with investing, which is very important now. They want to aggressively premiumize the portfolio and expand beyond just beer like all the other beer companies, which takes either a good valuation if they want to issue or money if they want to buy with cash or debt. But even with about a 75 million higher capex, they see about 1.3 billion in cash flow this year, which is very solid for the market cap. So they are both investing plus potentially helping the stock go up so that they can do better acquisitions. So I think this is pretty interesting. Overall, I'd say this is among the most interesting, if not the most interesting company in the video. All that premiumization of the consumer and stuff won't come overnight. It started, but this is about generational tailwinds that can take decades to affect them. And at the end of the day, we still need the cheaper brands, they aren't going anywhere. The way I see this is they have the current portfolio as a potential cash cow with limited growth, which they can use to develop well beyond cheap beer. If they can throw some 6-8% yields on top, then it's not bad at all. Not to mention that being relatively tiny, someone can buy them, especially if they fall too much, so there should be kind of a margin of safety. I'd say maybe if they can fall again to around 50 for a roughly 4% dividend plus massive buybacks, I think this might be a buy for me, depending on how the environment changes, of course. Now, Brown-Forman, this one is very popular thanks especially to Jack Daniels. They used to have some wine and others, but they shifted the focus towards especially whiskey and bourbon. This one actually fell quite a lot and is now back to the levels from a decade ago. They saw a pretty challenging environment, especially now with political uncertainty, but also did some divestitures to stabilize and cut some expenses. Despite it and an overall flat year, the margin is actually still very good, although it dropped quite a lot. Having a margin to lose is an advantage in such an environment. They can make around $500 million, which is not much at all for a 15-20 billion market cap. And keep in mind that they are downsizing, so we might as well be paying more than 30-40 times what they can make now, so a very high valuation. For them to return it back to us somehow, because that's the main idea behind it, they'd have to do so much better from basically a single brand. Financially, we see a great position with enough current assets to cover the total liabilities. Again, we see not a lot of equity compared to the market cap, so is the difference justified by the brands? I mean, Jack Daniels is very popular, but more than 10 billion for it is maybe a bit too much, especially since it doesn't make that much money. Does it offer enough for a potential buyer or anyone to be interested? Something to keep in mind for the smaller companies like this one is the possibility to be bought. Even a Chinese giant or another competitor could get this as a way to enter the market or diversify. It would be much tougher to have Diageo merge with InBev or Heineken, for example, because they would likely have regulatory issues. But overall, this one is a no for me. It's much cheaper now, but I just don't see the value behind it. Very healthy, but for this kind of money, I can definitely get better in my opinion. Not to mention the risk of basically relying on a single mature brand which has little potential to grow while the competition piles up. I think right now what they might actually be doing, and probably a very efficient thing, is cleaning the portfolio and looking for a merger or potential acquisition. Again, organically I really don't see that much potential. From an ethical point of view, I guess it's okay for me. I don't really drink that much or often, but comparing it to gambling or even smoking, I'm much more okay with this. It's much less addictive, and if you don't overdo it, it should be okay. Sure, you can have serious issues because of it, but for a vast majority, it's just something to have fun with their friends or family. To the same logic, why wouldn't all the corn and starch that ADM is selling be just as bad? It's causing obesity, direct and indirect health issues and more, but I wouldn't necessarily call it unethical because it's also food, just bad for you and something I'd recommend you reduce as much as possible. The company itself, sure, that's another story. So, interesting companies, and we see some clear trends in the industry. They seem to be shifting towards a softer drink approach, probably to respond to changes in consumer demand. It's still but not as much of a volume market nowadays as more of an experience. People thankfully started to not come home and chug a 2-liter bottle of beer or a 6-pack if you're American. A premium quality, carefully brewed half-a-liter bottle is much more enjoyable even if it comes at the same price. We see all the cider, premium brewery, low or even zero alcohol drinks and so on, and this also makes me think about the possibility of them getting into energy drinks as well. I talked about Celsius being a stock that I'm buying and a very good potential acquisition target, and given the trends, these companies might also be potential buyers. But also be very careful with politics. We see talks about massive tariffs from Trump recently and also potentially stricter regulations around the industry in general. It could potentially go as far as even banning them from traditional marketing, the same they did to cigarettes. That could affect them significantly, and it's a risk to consider in the long term. term. To be fair, I'd rather go for the agriculture behind it, but if you want specific exposure to the industry, there are a couple of decent options you could consider. Especially if Trump manages to push the prices even lower, scooping up some good companies at a discount could be an option even for me. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.